Let's get some analysis from Skyler Weinand, who's the CIO at Regan Capital. Skyler, great to have you with us. So do you think we're getting to a point, because it is the same messaging regardless of if you're listening to the Fed, to the RBNZ, to the RBA, to the BOJ, data dependent, patience is key. There's a level of readiness being signalled here across the board, though. Do you think markets have gotten to a position where they're not overdoing expectations?
Not yet. I think, we're neutral. We finally have gotten to that 3 Fed cuts this year, pricing in May or June. But the recent data that have come out, to me at least, point to the Fed waiting until the fall. We might not see something until September. And, there are folks that are pricing in potential, the next potential move might be higher. And I'm 50-50 on that. I'm leaning towards the Fed potentially having to raise rates before they lower rates. So I wouldn't get too ahead of what the Fed's going to do, especially if the BOJ raises rates here above that negative territory. Folks have been riding this yen carry trade since the late 1990s. So 25, years now that JGBs have determined really the rates of U.S. Treasuries. And JGBs really are still pointing to the fact that I think Treasuries have 30, 40 basis points higher to go. And I'm in the camp that we might see 5 handle on Treasuries on the 10-year before we see 3 handle again.
Well, late 1980s, I should say, 1989, December 1899 to be precise, is the last time we saw the Nikkei 225 trading at these levels. How are you investing around Japan at the moment? Is there a bit of profit taking around, perhaps some of the more crowded positions? As you say, Asia is kind of headed back to the 90s on this theme.
Yeah, and that's kind of my theme really is when you're looking at Asia back to the 90s. If we remember, Japan topped out late 80s and, led on to that eventually to the financial crisis in 1997. So I think JGBs are going higher. I see strength outside of China. I see strength in Japan, strength in India, strength in a lot of economies that are benefiting from deglobalization. So post-COVID, the world economy is deglobalizing, and I think folks are looking for, whether it be Vietnam or Korea, folks are looking for places to relocate labor forces, to potentially build outside of China. And so, focus on those smaller economies and be wary of what exactly is going to happen in China. I think the real thing that's going to determine China's success is how much stimulus the government really puts into their market.
But we have seen really that sort of run up in Chinese equities over the past few weeks, and we've erased those losses year to date. Some have turned a little bit more positive. Would you enter the market just from a valuation perspective? Because equities still are very, very cheap there.
Yeah, theoretically they're cheap, but I'm a little bit wary of I think it's going to be a bob and weave, so to speak. I think you have to wait for maybe a further sell-off and the government to come back in. But I think it's fully dependent on government support. Relative to Japan, you look at Warren Buffett's investments in Japanese trading houses that look very prescient now. Japan looks extremely strong. We're talking about raising rates in Japan for the first time in a very, very long time. And so I would stick with some relatively safe bets in where, real money's going, which I think is more of a Korea and India and Japan type of trade.
And there's safer bets as well. I mean, there's other areas you can go into that have lower risk and you can get, say, 7 to 10% returns, things like different parts of the bond market, for instance.
Yeah, no doubt. You're looking at one of the first times in the last 20 years, whether it be high yield corporates, municipal bonds, what we focus on, which is mortgage backs, that can offer well above that 5-handle yield you might get on money markets. You can put together a portfolio right now that's yielding 7 to 8%, extremely safe, and put on whatever duration you want. Whether you want to take on very little interest rate risk or whether you want to make a bet going out the curve in 5 to 10 year type of debt. So now's the time to be creative and to play quarterback, so to speak, on your fixed income portfolio.
Skyler, I just want to get your views quickly on one of the stocks we're watching in after hours today. New York Community Bancorp, NYCB, huge drop after it flagged this $2.4 billion hit to earnings. Broadly, we're getting more concerns that are coming in around regional banks and especially those with high commercial real estate exposure. How concerned are you by that?
Banks are in trouble, and it's a double whammy here on one, securities valuation. If they own bonds, those bonds have fallen in value by about 5 points over the last, call it 3 months. Then that commercial real estate exposure is in a lot of trouble as well. Multifamily real estate's down 20 to 30%. Office is down 50 to 60. And so it really, you have to pick apart that bank's balance sheet and where their lending is going. But the likes of a New York community bank that has a lot of exposure to rent-controlled apartments in New York, a lot of exposure to multifamily, I don't see an end in sight really for a lot of that debt. You know, we're looking at some debt that these folks own where folks are looking to refinance at 14 to 16%. So folks are desperate to get their hands on debt almost at any cost. And so these banks are facing down huge markdowns.
All right, Skyler, thanks for your time. That was Skyler Weinand, CIO of Regan Capital there.